This is me. So what makes a multifamily deal good in 2024? So we thought we would see a lot of really good deals in 2024, but it hasn't, it hasn't materialized. And one of the reasons for that is that most people, including some of our deals, to be honest, got variable rate loans. Most of our loans are fixed, but people got variable rate loans. And what that means is that your interest rate can change every month. And that was fine when the federal interest rate was 0% for like 10 years. But then we all know, you guys all hear about it, it went up 5.25, right? So this is the number that banks lend to each other. So if you're getting a mortgage, there's usually some type of premium, right? That's 2.5 to 3.5. So interest rates in the beginning, when people got the variable rate loans, were 2.5 to 3.5. So that's a great interest rate loan. So people were like, hey, yeah, my variable rate loan is going to be within this range. I have no reason to get fixed loans. Fixed was closer to 3 to 4%. And deals were so hard to buy that when you got a little bit more leverage, you were able to get better deals. And also, these variable rate loans also close quicker. So when you were in a rush to buy deals and you wanted to use every advantage you could, right? However, when it went up to 5.25, right? Let's say add 3, now it's 8.25%. And this this feels large, but let me give you an example. My house that I live in is at 2.37%. My interest rate or my mortgage payment is $6,000. It's like 5,900, but around it. Right now at 7%, this same house, nothing has changed. $13,000, right? Now, if you multiply this, it's a modest house, right? Not 5 million, not 10 million. But if you multiply this by a $40 million dollar house, right, or $40 million property, this payment you're going to be adding multiple zeros, right? Now this seems a lot more crazy, right? It's a little bit over double. It's pretty much no property can absorb that, right? So we've been expecting all these people who have bought these variable rate loans to go into foreclosure or be willing to sell and to distress, right? Well, what's happening is something called loan modifications. All these banks, you guys might have heard of the quote where it says, if you owe $1 million to the bank, it's your problem. If you owe $1 billion, it's the bank's problem. And this is exactly what's happening. All these banks have billions with a B of real estate loans on their books, meaning that if all of these went into foreclosure, the bank would collapse, right? If it was a couple at a time, they'd be able to take over, put someone else, get a new loan, right? But because there's so many properties right now that are in distress, right? Really, they can't afford to survive, that they're willing to get loan modifications and to go to. And some examples of loan modifications is an extension, right? Most of the variable rate loans were 3 plus 1 plus 1 plus 1, meaning it's a 3-year term. And then if you meet certain qualifications, you get an extra loan. This is where everyone is having problems because the certain qualifications, it's a little bit complicated, but right now it's like a loan to value, meaning your property is worth a lot more than the loan. Because most people are underwater, most properties have lost 20 to 30% in value. The LTV is a lot lower, uh, a lot higher, meaning that you owe your uh, loan is a lot higher percentage of your the value of your property, right? So they're coming on to 3 years, right? So 20 people who bought in 2020 through 2023, they're coming on to their 3 years. So what are they getting? They're getting an extension, right? So in the business, people say survive till 25. So survive till 25, meaning that interest rates should be lower then, and you're able to get a refinance or meet these extension requirements. So what does the lender do? They give you an extension. They will also let you decrease your interest rate. They'll also say, you know, those qualifications that you had to get, you don't have to get them. I mean, we'll just, we're not gonna, or we'll decrease the extension requirements, right? So because we're not seeing, so the people who sell right now, this all goes to say the people that are selling right now really have to sell. So, if you're buying a car and you see a car that's half the price or a tenth of the price, you're gonna wonder what's going on. And a lot of these properties, they suck, right? Their occupancy is like 70%, right? Their bad debt. So this is how many butts are in the door. And then you always got to look at these two numbers together. They go hand in hand. Bad debt, are people paying on time? If they're not, it's considered bad debt. Are you having to evict people? If so, that's considered bad debt, right? So one shady thing that pretty much everyone does is if you're going to sell a property, you just lower your standards to let people in, right? So if you have a credit score 600, all of a sudden you're happy with 550. So then your occupancy goes up, right? But also in a couple months, there's a reason that we look at credit. There's a reason we look at income reports. There's a reason we screen people, right? After a couple months after you sell the property, so maybe this is in the 90s, but you realize in a couple months that the people that you're buying from put in all these people that really shouldn't be able to afford or couldn't afford, and your bad debt goes up. So you want to make sure that these two numbers go hand in hand, that they're inversely related. So you have high occupancy and low amount of bad debt, right? So that's why most of the properties right now are sucking. But there's a couple things to look at. And if you look at those, I think, you obviously can't guarantee that you're going to have success, but you want to increase your odds in your favor, right? So the first thing is downside protection. So really the name of the game of investments is not to lose money. So that's why many of us invest in the stock market, right? So we do index funds, right? As opposed to picking stock. Every time I have picked a stock, it's guaranteed to like just steep dive. So I don't pick stocks anymore. I did it a couple times. I bought Peloton before it dropped. What else did I buy? Bought Disney before it dropped. So just a bad stock picker in general. So that's why I don't do stocks. So how do you make sure that you're really protecting against a downside on a real estate investment? You're looking at a couple things. First and most importantly, price, right? Purchase price, also called the basis. This is something that never changes. After you sign on the line, you send over your money, there's nothing you can do that changes the purchase price. So a big saying right now is date the rate, marry the house. This is so this is for obviously single family homes. So it says that, you want to make sure that this is okay with you, right? You don't want to overpay for something. And that's kind of what's happened last couple years when interest rates were low. people realize, right? Because your mortgage payment, and I apologize, I do not function well without a spell check. Is your interest rate and your purchase price, right? So back when interest rates were like in the twos and threes, like I had, people thought that they can buy a lot bigger house, right? A house that was a lot more expensive because these are inversely related, right? The lower the interest rates go, the bigger house you can buy for the same mortgage. However, the fortunate part on single family homes is most people locked in a fixed rate interest rate loan, or if they got a variable rate loan, they got a long variable like rate loan. So my mortgage, and the reason my mortgage was so low is because I got a 10-1, which is called an ARM, adjustable rate mortgage, but that means it's fixed for 10 years and then it changes. So the plan is to move out in 10 years. So that means I basically paid mostly just interest payments, very low. Uh, However, on variable rate loans, this can change on a monthly basis, right? So the same thing happened on commercial real estate. They bought much bigger property than they could afford because their mortgage payment was so doable. But with the variable rate loan, it went up a lot, really high. And the fortunate thing on commercial loans is an insurance product, interest rate reserve. And if you guys are here to talk about a deal, I'll talk about it briefly at the end, but really I want to focus on education so that you realize, if it's a right deal for you or not. So sorry, not interest rate reserve, interest rate cap. So this is an insurance product that says if interest rates go above a certain amount, that someone else will pay your interest rate. And this was very affordable back in the day because interest rates were stable for such a long time. But now, because they've gone up so much, as you expect with an insurance product, when there's more volatility, the insurance goes up, right? So for those of us that live on the coast, our insurances have gone through the roof. So I live in California, as I mentioned, and because of the fires, because of the increasing replacement costs, insurance has gone up to 2 to 3x per house and rental properties. Actually, for one of the apartments I own personally, the insurance company flew a drone over the roof and said they saw some pooling of water and dropped my policy. Wasn't anything I can do against it, right? So when you buy this interest rate cap, it used to be so, say you had a 3-year mortgage, right? It used to be, let's say 50 to 100 grand, right? And so if you were a good sponsor, you would put away that 50 or 100 grand. Actually, some lenders would require you to put that away. But now for that same thing is 800 million. So that is coming out from the profits, right? And that's why, unfortunately, you've seen a lot of capital calls or worse, some foreclosures. The amount of foreclosures is under 1% across the nation, but you have seen them. And this is the big reason because they just can't afford to go on because if you don't have this interest rate cap, then your interest goes up to the full amount, which could be, 9, 10%. And as I showed you in the example of my house, just a small, modest house, imagine a 40, 50, $60 million property is going to be a lot more, right? So the purchase price is very important because your mortgage payment always going to be based on it. And though you can change the rate, right? And get a new loan, you want to marry the house, right? Marry the house, the property that you like, and also the purchase price, right? So we've talked a lot about variable rate loans. What we actually like are fixed rate loans. And what that means is that for a set amount of time, the interest rate won't change. And these are usually actually from the government. So there's a couple reasons people don't like them. Um, so let's talk about the pros, right? Pros. Interest rate doesn't change. So this is the biggest one. So your biggest, just like your house, right? Your biggest expense on a monthly basis is your interest rate, right? Your mortgage payment. And so if that is fixed, then you're able to better predict your expenses, right? That can change. You always have that, like a sword above your head, uh, worried that interest rates are going to go up, right? So that's the biggest pros, right? Second, it's from the government. So they actually they want to encourage a lot of real estate transactions because if you imagine a normal real estate transaction, imagine buying your house. There's a title company, there's a real estate agent, there's a stager. Like in general, when real estate moves hands, a lot of jobs and economic activity is created. So because this is from the government, so Freddie Mac, Fannie Mae, they give you the best rates. The downside is hard to qualify. So we sign on our loans. So if you look at the loan document for the property that we're buying in 2 weeks, you'll see my name on it. You'll see Peter and Mitt's name on it. And that's a level above that what most people that do what we do um, actually do. But we think it's important. And we put our necks on the line for our investments. So to qualify, the other downside is, and this is something that people often don't talk about, is there's a prepayment penalty. Prepayment penalty. So this means, so imagine you're this government bureaucrat, right? You spent all this time to underwrite Pranay and a bunch of these doctors, and you're like, okay, fine, we'll give you this loan. 2 years later, I give you your money back. Now you got to go out and work to find someone else to give an investment, right? Even if you know you can make more money, you don't care, right? You're a government bureaucrat. It's not money in your pocket. So they don't want us to pay the loan back early. So for the current property we're buying, it's a 5-year loan. So what they say is that you pay us back in 3, 4, 5, or 3, 4 years, we're going to charge you a penalty. And that penalty is basically whatever interest payments they would have gotten for the full time. Excuse me. And so uh, obviously it goes down over time because the amount of interest that we give them over time, right? So anyone that invests in our deals, if it's a 5-year fixed loan, I tell them that only invest money that you expect to be tied up for 5 years. Because unless something happens, like the economy gets way better, which it might, we expect to be in the deal for 5 years. So that's the downside of fixed 5-year loan, right? But we love having our expenses predictable. And that's kind of a lot of issues, right? So the current people that are having issues, their interest rates went up so much that now, regardless of how well a property is doing, they just can't cover cash flow. And I'll give you an example of that soon. So if you're able to predict your expenses and you get the best rate possible while you have a good purchase price, this really protects you against pretty much anything that can happen. Obviously you can still have mismanagement and stuff, but if you have a good team on board, you can also have that. So, along with that, uh, next is the team, right? So the team. So you want to make sure that they have success specifically in the area. So we only work with and partner people that are local to the area, right? So the current deal that we're buying, the team called Sunrise, they live 10 minutes from this property. And we're in a unique position is they're actually managing it already. And uh, how do you assess how well a team is doing, right? So a couple of things you can look at. So occupancy, right? So you want occupancy to be in mid 90, 95%. So the reason for that is that if you're too high, if you're like 100%, that means you're probably leaving money on the table. One, if you're 100%, you can't do renovations, right? Because you need a little bit of churn for people leaving their apartments. And two, your rents are probably too low, because if every one of your units is occupied, then you can increase your rents on a regular basis, right? So we like to see mid to high 90s, so like 95 to 97%. So that gives you a little bit of churn so that you can raise rents and do renovations. So next is bad debt. So as I mentioned, these go hand in hand because people can they can make this number fluffy, right? They can fluff it up. But you can't really fake bad debt, right? So if people are not paying on time, people are getting evicted, then this number goes up. So we want to see this number 3% or less. And on this, we have a lot of programs that we use. So, we really don't want to evict people. So we have a lot of payment plans and a lot of stuff, right? But unfortunately, at some point, you got to do it. We never go into a property with the business plan of evicting people, which, yes, there are business plans where you plan on evicting everyone. But our goal is really to make sure that people are able to stay in their homes, but we give them a reasonable chance, right, to go. So, and on an example of a deal that we're buying right now, the current property is 97% occupied, actually 98% as of last month. So we know the property is doing well. They have one eviction that they're considering, but out of 177 units, that's well under 1%. And otherwise, everyone is paying on time. They're loving the property. So we know that the team and they've been managing for 2 years. After you buy a prop or after you start managing the property for 1 year, usually 1 year is where all the skeletons come out, right? Because it's the people that maybe they failed their credit checks and it's time to renew. You usually see things at the end of people's leases. Because even though, we expect people don't come in with that idea that they're gonna stop paying rent or pay rent less, but usually, especially now with a potential recession coming in, so having this and managing this property for 2 years really gives us a lot of confidence. You don't have to see my name anymore. See how we're doing on time. Okay. So next, what for making a multifamily great is cash flow. So how much are we able to do distributions, right? So that means I can pay off all the expenses. I have a large cash reserve. And if I'm able to put distributions out, our first deals, we really didn't focus on cash flow because as a physician, you don't really need a ton of money, right? An extra 80 bucks, 100 bucks, 200 bucks isn't going to change my life overnight per month. But having this ability to send distributions really marks a healthy property, right? Because that means it's covering expenses, it has a large cash reserve, right? And so this has become something that we like to see. But anytime that something becomes a metric, something that you follow, that you know that there's people that are able to take advantage of it, right? So what some people do is they will overraise, right? Actually, let me make this red. Overraise. Bad. So what they'll do is they'll say, because people love cash flow, right? What they'll do is they'll raise, part of their syndication, they'll raise an extra $1 or $2 million. I've seen $3 million or more. And starting month one, you get your distribution of 6%, which very few properties are throwing off that much money because especially in the first year, you're putting money into renovations, you have to change out the team. There's just a lot of expenses in your first year that you don't have in your second year. So usually cash flow normally goes up, but you'll see a 6 to 7% distribution. And what that is because they're over raising. So the downside of that is one, they're giving you back your own money, which kind of sucks. But the downside is that you're increasing your basis, right? Because every dollar that you raise extra means you have to beat that when you sell the property, right? So just give you a quick example. You're buying a property for 10 million, right? And then all in, including closing costs and everything, let's say it's 12 million, right? That means when I have to sell the property, I have to sell it for more than 12 million to break even, right? Makes sense. Probably 13 million because there's going to be more closing costs when you sell the property. I still have that same, let's say 10 plus 2, right? So 12 million. And then I overraise by, let's say, another 2 million. Now I have a $14 million property. And when I sell, I have to beat $14 million. So, obviously it's nice to get cash flow, but the basis, is something that you can never change. And that's why I have it as number one. So we don't like to do that. We don't do that actually. But that's a way that some people have been able to play with these cash flow numbers, right? So I think if you see a very large cash flow, just ask them where, is the money coming from operations or is it coming from another bucket from an overraise or from some people say cash reserve, right? So you got to just ask about it. Number three is opportunity for growth. We like to invest in deals that there's significant amount and opportunity for growth. So that you're actually increasing the revenue, right? Without just expecting things to get better, right? Because most people say we're at the bottom of the cycle. So you might have heard of Blackstone spending $1 billion on 10,000 units. KKR, another large multifamily company, just spent another $1 billion to buy some more multifamily. So most of these institutional players are coming in, and that's going to raise the prices for everyone else. So the properties that you own are going to be worth more. However, we want to see that there's opportunity for growth. So that you can go in and do renovations, right? But that the market is going to be able to accept those renovations, right? So you want to make sure that they're getting the rent premium that they deserve, right? On that unit. So here's a rule of thumb that it's pretty cool. So you want to ask them, how much are you spending on renovations? So renovation. And then multiply that by a year, right? And then you want to make sure that, and then by 12. Oh no, sorry. Let me change this. Renovation premium divided by cost, right? So for example, let me get on my calculator. What's that? So, okay. So for example, on our property, we're getting a $250 premium, right, in rent. And then times 12 equals 3,000. Cost. And so that gives you a return on cost of 25%. You want to make sure that this number is higher than the IRR that you're getting. So for our deal, it's up 14 to 16, right? IRR. So this return on cost, so this renovation actually makes sense, right? So remember that a lot of times people are going to be throwing numbers at you, but like, does it actually make sense? We talked to some sponsors and we asked them, oh, hey, these granite counters, is this normal in this submarket, right? Granite counters are nice. Obviously, everyone loves granite counters, but are people going to be willing to pay for it? And they said, no, this is just something we always do, right? That's at least a beige flag or a yellow flag, not a red flag, right? You should know some market by some market what it's going to handle, right? Okay, so this is return on cost. Return on. So opportunities for growth. So renovation. Um, so uh, population growth. You want to make sure that some market is growing. Employment growth. So you want to make sure that there's a lot of jobs coming to the area. So we really like Phoenix because there's a lot of high tech jobs that are coming there. So I actually didn't really realize this till a couple years ago when I started investing in Phoenix, but it's a big hub for electrical engineering, specifically semiconductors. So you may have heard that the government is spending $80 million to get semiconductors built into the US. And that's a lot of that money is going to Phoenix. So TSMC, the largest semiconductor company in the world, is building this humongous factory in Phoenix and bringing in a ton of high paying electrical engineering jobs. And actually, outside of Silicon Valley, most of the factories of Intel are specifically in Chandler, where we're planning on investing. So this is kind of, and then let me add one more thing to the downside protection. Downside protection, C, D, D. So you can see that we really focus a lot on downside protection, but that's the most important, right? So you can survive if you don't make your money, but it's really hard if you lose money, right? So we feel that in real estate, if you buy right and you make sure of all these other things, that the growth will be there. So it's really important that we focus on downside protection and cash flow. So D is your expenses. And so we already are focused on making sure that our largest expense is under control. But the other expenses that you can control are property taxes and insurance. So many people don't know this outside the industry. So most places in the South that don't have income tax, they're actually surprisingly progressive because what they do is they tax property owners. So property taxes on our investments in the South, in the Republican states, are through the roof. I'm saying 20-30% higher on a year by year basis. So talking about making your expenses predictable when your taxes go up that much is it's a lot, right? So if it's a couple percent on a $40 million property, that's going to really swing the needle in a large direction, right? So we like Phoenix because your property taxes are capped at 5% increase. And that's unique to Phoenix. And then the other thing about insurance, so the reason we own a property in Florida and our insurance went up 3x. So it went from 100,000 to 300,000, which is basically a whole distribution that we couldn't do because insurance went up so much. And we didn't have a claim, we didn't have any damage, we didn't do anything. But just because a lot of insurance companies are leaving the Florida market, the ones that are left have a monopoly and you have to be insured, right, as part of your loan documents. So because they have a monopoly, they can do whatever they want. So the nice thing about Phoenix is that because there's no natural disasters, hurricanes, tornadoes, wildfires, that your insurance costs are very reasonable and more importantly, predictable. So that really focuses on downside protection because you know these two expenses are going to be focused. In other places like Dallas and Orlando that we've invested, these have really caused us issues because they're no longer predictable and the governments are using property owners to kind of squeeze in some more income. So Uh, that's all we say, so really focus on downside protection, make sure the deal has cash flow, and there's an opportunity for growth. So I'm going to use our deal as an example to really highlight some of this stuff. And we'll send a deck out and this webinar if people are interested. We're actually almost full. We're like 97% full. So if anyone's interested, we'll try to get in relatively soon. Share. Okay, so here's the deal. It's called Sunrise in Chandler, specifically in Chandler, Arizona. So general disclaimer, this is for accredited investors only, which is $200,000 or more per year, or 300 as a couple, or a net worth over $1 million, only for US citizens or people that hold a green card. Also, these are projections. They're not guarantees of making. Okay, so here's the general gist of the deal. It's 177 units. Someone bought this, a New York bank bought this in 2021. They contracted Sunrise to manage it for them. And they made two mistakes. Two mistakes, which I hope you won't, because you have looked at this lecture. The number one mistake, and obviously it's easy to say this in hindsight, right? So that's definitely a little bias, right? They got a variable rate loans. And so their interest rate is currently about 9%. Number two, they didn't think they got enough leverage on their property. So they got a second loan called a mezzanine loan. And this is a higher percentage because it's a second loan. That means they have second lien on the property. They charge you higher interest. So this is a 15%, right? So these numbers were a lot smaller when interest rates were 0%, but now it's a lot higher, as you can see. So currently they can't afford to pay the debt. So that means they have two options. They can either sell the property at a loss, get wiped out, or they can just give it back to the bank. The reason they don't want to give it back to the bank is because no one's ever going to give them a loan again. If you have a foreclosure on your record, no one's going to give us or them loan again. So the current loan on the property is 50 million. We are buying it for 46 million. So we are buying it for cheaper than the loan on the property. All in, they are at 60 million. So we're getting a pretty large discount on the property. 177 units. But because they ran out of money, only 11% is renovated. Despite that, it's 98% occupied. And basically zero debt, zero bad debt. It's like $20 last month. So this tells me the property has been run very well and it has a lot of city of Chandler is one of the best places to live in. Population is growing, and as I mentioned, a lot of high electrical engineering jobs, and the unemployment is less than the nation's, like 3.1%. So here you can see they did renovate all the exterior units. That's why it looks so nice. And only 11% of the interior units. So all the interior units that you'll see here are just a couple of them. So because we're getting this for so cheap, it solves the downside protection issue, right? The basis of this deal is amazing. So we're getting it for $260 a unit. People have paid $385 a unit in the past. Now this was probably at the height of the market, but we think this just tells us that People like the submarket a lot, and there's an opportunity to get back there, right? It's a Class A location. It's one of the there's a bunch of independent breweries, independent coffee shops. The city of Chandler City Hall, like a mile away, means the police station's a mile away. It's a very safe area. A lot of jobs, as I mentioned. The property is being run very well. A lot of opportunity for growth because we're going to redo the clubhouse, make the gym nicer, and then renovate all the interior. And then supply limited competition. So specifically in Phoenix, there's a lot of brand new buildings that are coming, which is a concern, right? So if you have an older, this is built in 1985, you have an older place and a new place comes, it's going to be tough for you, right? However, the city of Chandler, there's only one new building that's going to come out in the next couple of years because city of Chandler is very hard to work with. So it means we have a supply monopoly. So here's the renovated unit. You can see it's pretty nice. This is the townhome. So here is the returns. So all these are net, meaning it's after all the fees. So 15 and 17% IRR, equity multiple of 1.9 to 2.1, meaning that you put in 100,000 at the end, we'll give you anywhere from 190 to 210, including your money back. It's a 5-year hold. We have a fixed 5-year loan. I tell people to only invest in money that you expect to be tied up. The minimum is 25,000. There are the cash flows, 3 to 5% in the first year, 4 to 6%, and goes up about half a percent to 1% a year. And here you can see an estimate of the yearly cash flows. So the waterfall, this is how money flows from the property to you, right? You can have the best deal, the best sponsors in the world, but if they get all the money, then it's a bad deal for you, right? So our waterfall is up until 8% per year, you get 100% of profits. After that is true, we send you all your money back. After both of those are true, we will get 75%. Oh, sorry. You get 75%, we get 25%. So people ask how we get paid. That's how we get paid. And there's no second waterfall, second set of fees. We only get paid along with Sunrise out of that 25%. Put in more, you get a little bit more. So you could get up to 9, 10, or 11%, and you could get 80 or 85% of the profits depending on how you invest. Now, if you look at the cash flows, you can see that this number is less than the 8%. So what the 8%, it's called preferred return. What it says is it's a protective mechanism. It means that 8%, 100% of the first 8% of the profits goes to you as an investor because you don't have control. So what happens if we don't pay that in a year, it gets added on, and it gets added on. So that means at the end, the first 40% of the profits has to go to you. And then after that's true, we send you all your money back, and then you get 75% of profits and we get. You guys have any questions? Definitely put them in there. Here are the fees. Only one level of fees. It's a 2% acquisition fee that gets paid only in the first year. 2% of management fee that helps us pay for everyone. And that's starting year 2. And importantly, that's on rent. So it's based on rent. So if rents go down, our fee goes down. And we like that as opposed to people will just charge a flat 2% based on how much you invest. But that, first of all, that's a lot, especially in the beginning of the deal. Let's say a deal is doing poorly. Why is someone taking 2% of your investment every year? So we like it basing on rent. It's based on our actual performance. Construction management, 5% looks really high, but it's based on of about $2 million. So it's actually only around $100,000. That's split across, over 370 investors that we have in the deal right now. Refinance. So as I mentioned, we're working with the government. Highly, highly unlikely that we do a refinance. But if it makes sense, we're going to have to hire a bunch of consultants to help us with that process. So the 1% fee goes to all of that. And disposition fee is a fee that gets charged when people sell or when we would sell the property, but we don't charge that. So talking about downside protection is a number we really like. It's called break-even occupancy. How low can the occupancy go and we still break even, meaning we cover all our expenses? So for the first year, it's 73.5%. And historically, the Phoenix area, the worst it's ever been is in 2009, which was 88%. And you can see that break-even occupancy goes down over the period that we hold it because the property is going to make more. So we like that, it's two standard deviations under what's the worst. So I mentioned a lot of this. We are going to do value add, it's cash flowing. The people that we're really trying to target are the people that are unfortunately priced out of houses. So the current housing market in Phoenix is like 600,000. So their mortgage payment is like 2775. So those are people we're really trying to. So we talked about this a little bit. How we're going to increase value. We're going to do renovations, increase the gym. The gym's like the size of this closet right now, and make the clubhouse nicer. I'll let you guys look at this. We really like Phoenix, a lot of employment, a lot of jobs, a lot of population growth. You hear a lot about inflation. Fortunately, it's going down, but multifamily seems to be relatively resistant. And you can see that it goes up during inflationary times. So depreciation is something that's one of the big benefits of real estate, but is very misunderstood, right? So think about if you bought a car for $30,000 and unfortunately you're getting sued 10 years later. You don't want the lawyer to look at your car and say, hey, add $30,000 to her net worth, right? Because you own that car. You'd be like, no, that car is worth $2,000, right? It's depreciated over these years to be worth less than it was before. And you can do the same for basically anything physical from the government. So you can do the same for real estate. However, in real estate, you get the added benefit of something called bonus depreciation, which you get an added multiple of your depreciation in your first year, and cost segregation, where you can take the various things like, hey, this rug is not going to last for 30 years. Hey, this whiteboard, this is only going to last a year, right? So you can front load it. So all of that combined of $100,000 investment, we expect about a 50% negative paper loss in the first year. So your K1, which is the tax document will say you got a negative $50,000 loss in the first year. So any positive return, so I mentioned 3 to 5%, so let's say 4%. So if you put in $100,000, you're going to get about $4,000 in the first year, and that will be added to your negative loss. So 50,000, negative 50,000 plus 4,000, so negative 46,000. So most people don't feel the need to pay taxes every year until we sell the property, because all you do is you have a large negative loss. So that's kind of the big benefit of real estate. You have this money you can use and you're not paying taxes. So here's a cool graph, kind of tells you where we are in the real estate market. And most people think we've hit the bottom or the bottom's passed. A lot of these large institutions, Blackstone, KKR, Starwood, are spending billions of dollars to buy real estate, specifically multifamily. So here's just a briefly about us. We do have an outside perspective. We have a very interesting network. Most people in real estate don't talk to each other, but we do. We get our foot in the door a lot of times because we say we're doctors, and then we haven't had a capital call. We're buying cash flow, and we do fixed long-term debt. So in terms of jobs, we have a full asset management team. We have something called major decision rights, which means that we have power to overrule anything that the operator, Sunrise, says. And that's really important for us as a way to protect our investors. And Sunrise is going to be managing the day-to-day. So there has been some worry in Phoenix about new units coming live. But as I mentioned, city of Chandler is very difficult to work with. Also, Phoenix, about last year, they passed a law that says you've got to prove you're going to have 100 years worth of water. So it's basically impossible to get a new permit right now. Someone's going to figure that out in the next couple of years, but by that time, we'll be out of this property. So here's the property summary. One thing we really like about it is that it's only single story, other than the townhome where you own the top and the bottom. So it's very family friendly. You can look at the floor plans. Everyone has a patio, which is important. There's a ton of covered parking. It's all gated, so it's really safe, a place for people to raise. So you've seen pictures of the amenities, so I'll skip that. Interior, this is the scope, right? It's going to be really nice. We're replacing everything basically. So, very modern. You can look at this, a lot of different types of jobs. One of the best places to live, city of Chandler. You can see the median income, 116, so very affluent area. Intel, as I mentioned, right? So one of the top employers, and they said they're going to put billions into the area. Business plan. So we're going to do the interior renovations, the clubhouse, make the gym a lot nicer. Here's the units. A good mix of 2x1.5s, 2x2s, and 1x1s. And a lot of these rents they're actually able to get already, so people, so we expect these to be very possible. We're going to do renovations and we expect the market to get a little bit better. Here's the cost. I'll let you take a look at that. So sources and uses. So this is something to really focus on because leverage, right? Leverage is how much loan you have, right? Divided by value, and that's LTV, or LTC, which is the cost, right? The cost of everything divided by loan, right? So we like to see around 65 to 70%. LTC. We like LTC because it includes everything, right? So some people will only include the value of the property and the loan, but what about all the renovations, if you overraise the cash reserve, right? So we like to see LTC, right? So one thing you can do, right? So you take the loan, right? So ours is 29.9. And here's one thing that's really important. If there's any preferred equity, you got to add that on, right? Because you want to make sure how much money is in front of you to get paid, right? So that's what I look at leverage, right? So divided by 52, right? Let's say 52 million. Because we're buying it for 46. And then it's like we're bringing the renovation budget to the table, right? So that's like 3 million, and then there's closing costs. So in roughly around 52, right? So this is about 69.5%. Kind of right within our budget. In terms of LTV, right? We have a broker's opinion of value. We're buying it for 46. But a broker's opinion of value. So you take it to a broker, and you say, how much do you think you can sell it for? He actually said it's going to be 49.5 million. So it's 29.9 divided by 49.2, so about 72%. The reason we don't like LTV as much, I mean, this is pretty reasonable. It's a little above what we wanted, but the reason we don't like this is that we're bringing to the table, right? So for renovations, this doesn't include renovations. Usually people will look at LTV when they have variable rate loans because the amount of renovations will come from the lender. So we have preferred equity, and I'll talk about their terms. So we are buying this at a 6 cap, and I'll talk about cap rates in a second. So the loan is 29.5, 5 years of interest only. Rate will be around 5.9%, and LTC for the loan alone is about 57%. We have preferred equity, it's 5 years of interest only. Their terms are actually lower than we were able to negotiate for less preferred return for them. It's 7%, 8%, and 9%. And then their all-in rate is 14%. So it actually increases our returns by a little bit. And their LTC is 11%. So if you add these together, it's about 69.5%. The thing to mention about preferred equity, this $6 million, right, is treated as a second loan. So it gets treated. So basically this is, so 36. So we treat it as a loan, but still has a reasonable leverage. And then here's what we expect to sell at. So I'll talk about cap rates here. And then we'll go over to pro forma. Okay, so a cap rate equals purchase price, NOI, so your income, net operating income, divided by your purchase price. Right. So basically, how much am I valuing a dollar event? Value of a dollar of income. Right. So let's think about this without numbers, just think this through, right? So if I'm buying something, I want the value of a dollar to be low. Right. So yeah. So I want the value of a dollar of income to be low. Right. If I'm selling something, I want the value of a dollar income to be high. Right. Kind of makes sense. So if I make, if my property makes $10, I want them to value that $10 a lot if I'm selling. But if a property makes $10 and I'm going to buy it, I want to value it as low as possible, right? So this translates into high cap rate and low cap. So we are buying at a 6%. Most people in Phoenix are buying at a 5.3. And you don't have to worry about the absolute numbers, but you want to buy at higher than most people are buying at. So we think we're going to sell at a 5.5. So if most people are buying it at a 5.3, and we think we're going to sell at a 5.5, because this is higher, we think the market is going to get a little bit worse than it is right now, which is really hard to imagine in terms of real estate. But here you can see, this is called a sensitivity analysis. It shows you when we sell the property, what kind of numbers that we're getting. We're getting at a 6, and we think the property is going to get even worse than right now. Well, maybe hit at 11%, right? Depending on what the rent growth is. Most people are predicting around a 3.5%. And most people are actually predicting cap rates will be like 4.5. So much higher than this, but we thought conservatively we would have around 14. Another thing is our vacancy, as I mentioned, it's 98%. So our vacancy is currently down here. So it's 2%. We put 5.5 into our pro forma, which is up here, because it just gives us a buffer, right? Like, how do we make this deal really pencil in and as conservative as possible, right? So we're taking, even because they've been able to run the property better for the past 2 years, we expect things to get worse, right? It probably won't. It's shown that they won't, but just in case it does, right? So I'll let people look at pro forma. Here you can see that the current cash flow pre-acquisitions is negative. We're going to be making immediate cash flow because, as I mentioned, they have a $50 million loan at, let's say, 9 plus 15%. So let's say blended 12% loan, right? We have a $30 million loan at 5.9%. So this is why we're making money immediately. Our first distribution is going to go out in about 2 months, and then we pay monthly after that. The other thing to look at is payroll. We like to pay our people very well. You can see payroll actually goes up slightly, and everything else is relatively similar. You want to make sure that this number is not too different, right? Because first year is always tough, right? We expect it not to be as tough because Sunrise is currently operating this deal and they've been operating it really well. So we're going to hire them as well to run our property. And then so cash on cash, you can see that. So you can see sales comparables. The problem with the comparables is there's just not many properties that have been sold or bought in the Chandler area. So we included stuff that's brand new that really can't compare to us versus things that are old and comparable to us. So you can see that. So you can see people have paid way more, right? And people have otherwise paid very similar rents. You can compare. We are a bit higher than other people that are in the area, but because ours is a lot nicer. All that you can see, the pool, all that stuff is renovated. So we're really comparing ourselves to these people, the people that are relatively new. So I'll let you talk about Phoenix. Great place for business, economy. Here's us. So I'm Pranay. I'm one of the founders, hospitalist. We've been doing this for 4 years now. Done a lot of real estate. You might know Peter Kim from Passive Income MD, and then Myth is our third person. Here's our track record. We have bought around 1,500 units. We have 2 exits, 18 IRR and a 10 IRR. 10 was last year when there was a lot of volatility. We asked our investors if they wanted, positive return. It was like a 20% return in about 18 months. They were happy with it, so we sent them that money back. In terms of our current deals, we have 11 deals going. 7 of them are distributing on schedule. One is going to restart relatively soon. That's the one that got hit with a lot of property taxes. It's in Oklahoma and insurance costs. One is in Florida, where our property taxes and insurance went up 3x. And we're never investing in Florida again. That property has a 9-year, 3% loan. So we expect to probably sell that for a large return, large positive return in a year or two. 2 of our deals are struggling, and because they have variable rate loans. I think they'll be okay. We got loan modifications on them, but they taught us 2 lessons. One, fixed long-term debt, which we do. They were 2 of our first deals, and then invest for cash flow. So I think they'll turn out okay, but we learned a lot of lessons from them. Here's Sunrise. They are going to be running this property. You can see their full cycle returns. The numbers are a little wild, as usually are first couple deals, but we think they can show that they will be able to be successful. And lastly, here is Enclave on Destiny. The first deal we did on Sunrise. We bought it about a year and a half ago. We're already hitting year 3 rents. We've increased NOI 24%. And we bought this in 2021. So, right at the height of the market, but regardless, it's been doing very well. So lastly, you can invest through retirement accounts, but the deal's almost full. It's 97% full, so we wouldn't have the time to do that. It's 506C, so only accredited investors. Distributions will start in about 2 months after we close. Close date is July 15, but I think the deal will be full before that. Distributions are monthly. We give monthly reports. I promise you'll know more about this property than you want because we over communicate. You have to be accredited, and yeah, we talked about the preferred return. Cool. That's all I have. If I'll put the link if people are interested for more information. But yeah, happy to take any questions about real estate in general or this deal.
Hey, Pranay.
Yeah. Hey.
So I got a question about, I think, about you're talking about one of your deals that there was this fixed rate variable. Actually, I put my question on the chat, but
yeah, awesome.
Like, how much higher is usually a fixed rate compared to a variable rate? And if that stability, when you get that stability, is it worth the potential cost difference?
Yeah, great question. So, it's easy for us to sit here and be like, oh, why would a dummy get that, right? But there's a couple reasons, right? So the government is slow. So we started this deal, 2 months ago, and we're still not final on the loan. We're there, but we're almost done. So variable rate loans, right? They can close fast. Better interest rate. So not by much, right? So if we're getting like, let's say 6% from fixed, maybe it's like 5.2 from variable. Not a huge difference, but the close fast is quick. More proceeds, meaning you can get more leverage, right? So leverage, double-edged sword, it improves the returns, but it also increases risk. So they'll go up to 85%, right? So our all-in, if including the preferred equity, is 69.5. They'll go up to 85% by themselves, right? So if you're having problems closing your deal, right, it also means you got to raise less money, right? So it should make the deal easier, right? They'll pay for renovations. So not only will they give you more leverage, they'll pay for renovations. While fixed, you have to bring the money. So we're bringing 3 million to the table. That's 3 million that we have to raise, which for renovations for variable rate loan, someone that used a variable rate loan. And this is tricky. If you think interest rates are gonna fall in the next couple years, it might make sense to get a 3-year variable rate loan, right? And that you can get a refinance. Oh, and no prepayment penalty. That's a huge one, right? So if you look at our waterfall, right, you get 100% of the profits as an investor till 8%. You get 100% till all of your money, so return of capital, and then you get 75% of profit. We get 25. So you can see we really don't get paid till the end. So for people, if they want to get out of the deal early, that means they get paid early, right? So some people will try to sell at 2-3 years, right? But you're taking a risk, seeing how the market is. All the people that got 3-year loans in the past couple of years, they're the ones that are facing problems because they wanted to get out of this, right? So there's a lot of other reasons to get a variable rate loan. We just, we're okay with this. We don't want we want our highest expense to be taken care of, and we're okay waiting, right? We're okay bringing the money to the table. We actually want low leverage. We don't want more leverage. And then we've been, people, we have a relationship, we have a track record of closing, so people are willing to wait for us to work with the government.
Got it. Got it. All right, cool. So I think we're over, but great. Thank you, Pranay, for this. I really learned a lot. I actually took notes during this call. For those on the webinar, look out for an email from Ascent Equity Group as a follow-up with information. Again, thanks for stopping by, and we'll hope to see you guys soon. You have a great day. Take care.